Bonjour et bienvenue. Welcome to this webinar on the results of the November 25 joint carbon market auction and the domestic politics of California and Quebec. My name is Marc Purdon of the Université du Québec à Montréal. I am the holder of the chair in decarbonization here at UQAM. We have a great set of speakers. I'm joined also by Séguin from UQAM, the Department of Economics. But we also are very pleased to have Alicia Robinson and Clayton Munnings from Elevate Climate on this call, this webinar with us. So we'll wait just a moment to allow participants to enter, and then we will continue. C'est un webinaire en anglais, donc on va procéder en anglais, mais si vous avez des questions en français, n'hésitez pas à nous poser vos questions. So we will be presenting in English, but if there is any questions from our Francophone colleagues, please feel free to pose your questions in French. I'll wait another few seconds. We're seeing participants come in. Bienvenue. Maybe I'll just get started here. So what we're going to do today is we're going to kind of go through the numbers of the November auction that was held on November 19th of the California-Quebec carbon market under the Western Climate Initiative. Look at prices obtained, emissions allowances purchased by compliance entities, percentage of emission allowances sold, revenue generated. And then we're also going to get a bit into the domestic politics surrounding the carbon market in the two jurisdictions. And we're really, really pleased to have speakers that are really quite involved with these discussions in both jurisdictions. So I'll turn over the slides to my colleague, Charles again.
Okay, so here you have the context of the reduction targets, because the purpose of this joint Quebec and California market is to reduce emissions to reach different targets that each jurisdiction has given itself over time. So there was a target in 2020. And now there's a next target in 2030, and then jurisdictions have objective of being carbon neutral in terms of net emissions, 2045 or 2050, depending on the jurisdiction. So here you have the numbers for California and Quebec. It also gives you an idea of the relative size of the jurisdiction. So obviously California is the big player, and Quebec is the small player. So if you want to think about this in terms of international trade, California would be the price setter in there, and Quebec would be the price taker in the couple. And we also put the numbers for Washington because it has its own, the state of Washington in the U.S. has its own cap and trade system that they call cap and invest. And there's discussion ongoing about linking the system in Washington with the joint system of Quebec and California. And also we have the numbers for Canada, because when we come to the political climate, we're going to refer to decisions, several changes that have been made at the federal level, repealing a certain number of climate mitigation policies recently that may put pressure on what is happening in Quebec. So you get the system is defined right now to 2030, and California recently announced that it's going to prolong it in the future. So you get the trajectory here of the allowances that are distributed in the system. The little jump that you see from 2014 to 2015 reflects the fact that in the initial period, it was only large industrial emitters that were covered by the system. So maybe about only 25% of emissions in the case of Quebec. And in 2015, most of fossil fuels became covered through the inclusion of fossil fuel distributors in the system. So that increased the coverage level to 75 to 80% of emissions, and that also increased the level of allowances in the market. Then you could see that the trajectory for California, which is in red, and it's a little bit more difficult to see for Quebec because it's so much smaller, but both are decreasing over time. So the cap is becoming more stringent as time goes on. The auction that we're talking about today is the November auction. So there's four auctions every year: February, May, August, and November. And the data for these auctions always gets published 1 week after the auction. So it was last week that it was published for the last auction. And it's a multi-unit auction with a price floor. And sometimes for a long time the floor was binding, but then after the pandemic restrictions were lifted, we saw the prices. We will see the data soon increase significantly above the floor, and then recently they went a little bit back down, and we're hovering just above the floor recently. For those who are more familiar with the federal system, so the feds used to have two different systems for consumers and for large emitters. For Quebec and California, those two systems are combined, but the way that large emitters, especially the trade exposed ones, are treated differently than fossil fuel distributors is that they receive a large proportion of their allowances for free. So they can buy more if they want at the auctions, but there's also grandfathering of allowances to large industrial emitters. So now we see the evolutions of emissions for California and Quebec from 2020 to 2023. And then here the point is especially to highlight the fact that because the jurisdictions are joined, there is a net flow of emission allowances between the jurisdictions. So if we look at the combined graph, the one in black, we can see that even before the pandemic, the objective for 2020 was reached by the joint jurisdictions. But if we look at jurisdictions separately, California and Quebec, well, California went beyond its objective in 2020, and Quebec stayed above its objective. But there is a mechanism in place agreed by both jurisdictions to account for the net trades between the jurisdictions. So that's the numbers that are in blue at the bottom. That says, well, in 2020, in terms of territorial emissions, the reductions in Quebec were 13%. But if we account for the net trade and allowances between the two jurisdictions, then it was 27% below, meaning that, Quebec emitters on the net bought allowances from California, forcing California firms to reduce their emissions more and allowing the Quebec sector to stay above what would otherwise have been their emissions in an autarkic situation. Okay, so now we get to the auction results. So we see the numbers, US dollars, Canadian dollars. So the price floor was at about 26 US dollars or 36 Canadian dollars, and the settlement price was about 2.5 US dollars or 3 Canadian dollars above the floor. So we stayed above the floor, which means that all the allowances were sold at the auction because the demand was strong enough. But at the same time, it's not as much above the floor as it has been in the past. So that's what we see. Briefly mentioning that here you see two graphs. So one at every auction, there's always two vintages of allowances being sold. A current vintage. So for the November 2025, it was a 2025 vintage that's valid for emissions from 2025 onwards. And there was also a 2028 vintage that was for sale. That's only valid starting for emissions in 2028. And we can see that the pattern and the price level of these things is relatively similar. So it was very close to the floor for a long time. It picked up from the floor in 2021 when the economy, came out of the pandemic restrictions, and it stayed on an ascending trajectory pretty much through the end of 2023. And then with worries about inflation coming about in 2024, central banks increasing interest rates, economy slowing down, then the levels started going down during the year 2024. And of course, with the trade war that the Trump administration started in late 2024. It kept that trajectory going. We hit back the floor uh, in May of this year, and then the last two auctions have been a little bit above the floor, and that's both for the current vintage and the future vintage. And then you see these same numbers if you prefer the Canadian dollars. Then these are the same trajectory for the Canadian dollars. Sometimes it can change the movements a little bit if the exchange rate has moved a lot in between auctions. So you could get the impression that it's going up in one currency and down in the other if there was big swings in the exchange rate. But there wasn't that much of a big swing in the last auction since the August auction. What we see here is you have two types of players in these auctions. You have the regulated entities, which are face compliance obligations under the rules both in California and Quebec. So basically, they're the regulated emitters. And you also have other peoples who can join in these auctions to buy these allowances, mainly, I would say, as a speculative investment. So the relative proportion is almost always in this direction, which is that the presence of speculators is more pronounced in the future vintage. So we see here that about 30% of the allowances for the future vintage have been bought by non-regulated entity, which we can think of speculators, and about 18.5% only for the current vintage. So I think that there's maybe two dimensions going on here. Well, the volumes are much smaller. For the future vintages, there's much less to be sold in the current vintages, and also probably it gives us an idea that the speculators maybe are less financially constrained than the regulated entities, and they may be also a little bit more patient, so they're willing to hold these future vintages for at least 3 years before they become usable in the market. So maybe it's a waiting period that the regulated entity are a bit less willing to go through than the regulated than the speculators. So what we can see here is the time series for this proportion of allowances bought by regulated entities. It's relatively somewhat decreasing over time, and we can see, especially for the future vintage, it has been particularly low at this last auction. It was the third lowest since the system has been in place. So I don't know. In a way, we could see that maybe there's more concern about from regulated entities about value of the allowances in the futures, and the price being that low, the speculators, swooped in and got a bigger fraction of the vintages of the future vintages for sale this time around than they usually get. In terms of the current allowances, it's been pretty stable between 80 and 90% over since the pandemic, I would say. So that's what we see here. You can see, I guess, three things in this table. First is that, of course, because demand was strong enough, all the allowances were sold and the prices was above the floor. If the demand is not strong enough, then not all the allowances are sold, and the number that are sold is the number that the market is willing to buy at the floor. But in the case of last November, then everything was sold. You can again see the relative size of each market, with California selling about 4 times as much allowances as Quebec, and you also see the relative size of current vintages compared with future vintages, where future vintages are about a fourth to a fifth of what the current vintages are. So it's a smaller market for the future vintages. Oh, funds. Okay, so funds, there's been a lot of discussion recently about the use of funds on the Quebec side, because the government changed the use of the funds. It used to be restricted only for further climate mitigation or climate adaptation. And now the door has been opened to use it also for other government purposes, in particular to pay the debt. And we can see that with the weakening prices in 2025, there's less revenue that has been generated compared to the last few years, where the prices were increasing. And also remember that the quantities are decreasing. So for the revenues to be increasing over time, the prices have to grow faster than the quantities are decreasing. So that has not been true in 2025, but it was true in the post-pandemic period. And the numbers at the Quebec scale are kind of significant. We're talking about $1 to $1.5 billion a year in the past 5 years, with a total of almost $11 billion since the system has been put in place.
Great. I'll jump in here to discuss revenues on the California side. And this figure, as well as the graph, is from the 2024 annual, or 2025, excuse me, annual report of the California Climate Investments Program, which is managed by CARB, and it is the program that also manages and disperses the Greenhouse Gas Reduction Fund revenue, which is generated from the Cap and Invest auctions in California. So from 2013 to 2024, the Cap and Invest auctions in California have generated roughly $33 billion. And this chart here just shows kind of the process by which the revenues are appropriated by the California legislature and then awarded to different programs and then ultimately implemented, in other words, dispersed. And so there's sort of you can see here kind of a waterfall or a three-part process. After the auction revenue is sort of generated, the legislature has to appropriate it, and then the various state agencies and get awarded the different sums of money in order to then fund different projects. And currently, the California climate, sort of the GGRF, the auction revenue, funds roughly 117 climate programs across the state. We will get into this in a moment, and Clayton will speak to this in a few slides, related to a change in how the GGRF revenue will potentially be implemented as a result of legislative negotiations this year. Historically, the certain funds have been continuously appropriated, which means that they are directed to specific programs established by statute, while there are other sort of pools of discretionary funding for the legislature. But it seems that this sort of historic approach might be changing as a result of the legislative negotiations, which Clayton will discuss in a moment. And now I'll hand it over to Clayton to sort of provide additional commentary on the pricing section.
Yeah, sure. I'll just remark on the joint prices that Charles made from a California perspective. So I think many onlookers expected prices to appreciate more after legislative extension. Our view at Elevate Climate was always that, well, first, the high watermark for prices was around $41, as is shown on this graph. Our view was always that the supply cuts through the rulemaking process was more important to price formation than legislative extension. In other words, concerns over the timing and quantity of supply cuts kind of preceded legislative extension. And while extension was important to secure that this is a market at the end of the day and supply and demand drives prices, and that I think is one of the fundamental reasons why prices remain lower than many onlookers thought they would be. Now, in addition to this, Alicia will elaborate on these 2 points later on. The rulemaking that CARB has now informally resumed has outlined how many allowances may be cut from the market, and there's some uncertainty around how many allowances will be cut in terms of supply. And in addition, the second point is that there is still some concerns over a Trump lawsuit, which is also chilling the market to some extent. So there's a fundamental reason and then like two headwinds for why these prices remain not at the floor, but close to the floor relative to many expectations.
And so now we're going to turn to a bit of the domestic politics, and we're going to start with what's happening in Quebec. And Quebec is, of course, influenced by what's happening at the federal level in Canada. And I'm sure everyone is aware on the call that the big story earlier this year in March was the federal carbon tax was revoked, or at least set to zero. And the political ramifications of that has led to perceptions of unfairness in some parts of Quebec. There is a conservative party of Quebec, and there is a conservative populist kind of coalition in Quebec. And there's been questions about, the price of gasoline in Quebec is higher than now it is in Ontario and New Brunswick, neighboring provinces here, because we have the carbon market price on gasoline, whereas it's now been removed from those other jurisdictions who were subject to the federal policies. And this even came up in there's the Journal de Québec. It's a tabloid news paper. Did some public opinion surveys that were claiming that there is considerable disapproval of the carbon market price. They even call it a carbon tax. They refer to it as a carbon tax, even though it's the market instrument. There's been some critiques of those surveys, but anyway, they've been out there. Another initiative was there was an August by-election in Quebec, and one riding. This is sort of a special kind of election. And what was interesting there is that the Conservative Party of Quebec candidate came in second there. They didn't win, but they came in second. And the Conservative Party of Quebec doesn't have any seats in the National Assembly of Quebec. So it was sort of like a coming out, and a lot of one of the key campaign messages was to get rid of the carbon price. At the same time, while we had these critiques of the carbon price being too high and unfair, there are some critiques on the other side of the political spectrum that are saying that the carbon price is too low. We need higher carbon prices. And I think Charles showed earlier in his discussion of the emission trends in Quebec is that if there's a reliance on the emissions trading system with California to meet our 2020 and essentially to our 2030 emission reduction targets. So is Quebec going to be able to raise prices to reduce emissions further on Quebec territory? There's some discussions about this. There's some research that suggests that, if Quebec is not going to link with California and try and reduce emissions and meet its current 2030 target, the prices for emissions would need to rise substantially. I've seen numbers of around $300 per ton by 2030 to meet the 2030 target of Quebec on Quebec territory. But then that leads to some questions about the target, and I'll maybe hand it over to Charles at this point.
Yes, so maybe to take a step back related to what Clayton was mentioning about the new California rulemaking. So it has been Quebec had been waiting for a long time for California to do its new rulemaking. There was a message to market participant that the government of the Ministry of the Environment of Quebec published in October 2024, where at a time at which maybe the mood was a little bit more politically favorable to carbon pricing, where they announced they would be cutting supply of emissions, they would be reducing access to carbon offsets to regulated entities, and giving indications that the market would be prolonged beyond 2030. But that was waiting for California to do its rulemaking. So at first, they announced that these rules would be made explicit in early 2025, but then as things dragged a bit along on the California side, the rules were never made explicit this year, or at least a change to the rules on the Quebec side were not made explicit, and the political climate, as Mark has mentioned, has changed a little bit. So there was, I think, a brief period where some of the political parties that are represented at the Quebec National Assembly flirted with the idea of getting rid of the market. I think that has not lasted very long because of the major difference between the federal carbon tax and the Quebec cap and trade system is if you get rid of the market midway, like Ontario did in 2018, you have to compensate people to whom you've sold the allowances. So it costs you a lot of money compared to canceling the carbon tax, which you have not sold to people an instrument that you need to compensate them for if you cancel the market. So I think once people realized that, there was a lot less talk about getting rid of the cap and trade system in Quebec, but maybe ideas about inputting more flexibility. So in this fall, the Minister of the Environment changed, and the new Minister of the Environment gave the signal that his role was to ease environmental constraints to favor a more dynamic economy and maybe fewer pressures on the purse of consumers. And that has translated in this rule change in the use of the funds that are generated from the auctions. And now the government has allowed itself to use part of the funds generated by auctions for non-climate related uses. And in a recent fiscal update, last month, the provincial government announced that $1.8 billion from the auction revenues would be used to pay off a part of the provincial debt. So that was one of the uses. But I feel that there was mixed reaction to that. Some environmental groups were very upset, but others were relieved that at least the money was not used to reduce the gasoline tax, which was another option that was made possible, or used to finance the road network, which was also something that was evoked. So in terms of using it to reduce the debt, people felt that maybe it wasn't the worst choice, giving alternative possibilities. And then right now, the government is holding public hearings to reassess its 2030 target, the minus 37.5% currently compared to 1990. And I feel that everyone feels that early indications from the new Minister of the Environment is that he finds that reaching this target will be too costly. And even though the system will stay in place, the cap and trade system, the target may be reduced. And when you read the report that was floated by the ministry, you feel that maybe like 25% is the number that they have in mind right now in terms of a target for 2030.
And well, thank you, Charles. The other big issue that is going on in Quebec is a revision and the whole energy policy. And that's been quite politically salient. And that's important, as some speaker participants here on this call surely know. Quebec produces considerable amounts of hydroelectricity, exports some of that to the northeastern and United States. Some of the cheapest hydroelectricity rates in North America. But what's important to know is that over the past 5 years, the projections of producing a surplus of electricity have moved to projections of a deficit if changes aren't made. And this has prompted a series of changes, one of which is the adoption of a new Bill 69 legislation just in June of this year for the governance of the energy sector. There's going to be a more rigorous planning process that's in place. But there's been many debates about that governance structure. There's now also debates about whether tariffs should and how they should increase, and which segments of Quebec society will pay for that increase. There are some protections for Quebec residents, but other consumers, small, medium enterprises, large industry, it's going to be interesting to see how the projected rise in tariffs is going to be distributed, and that's something that's now being discussed through a planning process. There's a whole new also plan to increase the capacity for power generation at Hydro-Québec, the main power generating authority here in Quebec. It's going to increase capacity by 50% by 2030. That's the plan, and to double capacity by 2050. And so this is a massive project that's now under being formally discussed in a formal planning process, which is also newly instituted just since this bill was adopted in the summer. And related to all this, there are some, how much power should be exported. That's also something that kind of, should Quebec be trying to build more export markets in the United States? That's something that is also kind of in the mix. Not to kind of cut back on current commitments, of course, because those are done and signed, but to decarbonize, really, Quebec's idea is to electrify the economy to a greater extent, especially through electric vehicles and some other electrification technologies. I don't know, Charles, if you have anything to add to the energy policy issues.
Well, I think the energy policy will play in the affordability issue. So because, rates may increase for consumers faster than inflation, as it was recently floated, contradicting an earlier promise made by the government, then, concerns about the impact of the cap and trade system on affordability, even though it's mainly perceived affordability, because actual measures of the impact of the system on inflation show that it's pretty low. But the perception, will be more salient on the affordability dimension because of changes in electricity pricing.
So just to kind of conclude this slide, it's just the climate policy and energy policy have both become much more salient over the past year or so than in the recent than previously. So that's just something that we'll be paying attention to. And now I'll turn it over to the California side.
Yeah, thank you, Mark. So I'll just give a brief update from California with kind of one slide on background, one slide on legislative extension, and then one slide on kind of what to expect from here. And I guess stepping back and going back in time a bit, our regulator CARB did start an informal rulemaking process in 2023 for a variety of reasons that was delayed, as Charles had alluded to, and ultimately paused to make way for legislative extension. There were many motivating factors for that, but one of them was a perception that the legislature could more easily address affordability concerns around the program and could pose affordability solutions easier than the regulator just because they have a wider toolkit available because they can create new laws. And fortunately, this year, the legislative extension succeeded. If you weren't following like the day by day, I think the political aspect to report back is that the negotiations happened in a very small room, very kind of secretly, without much text or ideas being shared even among legislators, and kind of came together in the very last minute. So, in other words, getting an extension done this year was far from guaranteed, and we're lucky that extension has succeeded. In terms of the content, I think we can go to the next slide here. But in terms of the content, what you see really is two bills. So AB 1207 from the Assembly and SB 840 from the Senate. And if I had to kind of characterize the push and pull between the Assembly, the Senate, and the governor's office, which were the three negotiating parties here, I think the governor's office clearly wanted to address affordability concerns and make affordability solutions. I think the Assembly really led the way on extension and affordability, and that is reflected in the content of their bill. So I'll elaborate on that in a second. But kind of the headwind mostly came from the Senate side for a variety of reasons, but most importantly, I think, is skepticism over market programs generally, and particularly skepticism pertaining to offsets. So at the end of the day, what you got was a set of bills that I think do three things. The first thing is just what I'll call housekeeping, formal extension of the program through 2045, renaming the program Cap and Invest instead of Cap and Trade, and then making sure that the caps are actually explicitly more connected to our targets that are in statute. So that's a 40%, at least 40% reduction by 2030 and an 85% reduction in covered emissions by 2045. So those were kind of the housekeeping items that spoke to the basics of the program. The second set of provisions you see is a set of provisions, I think, mostly addressing affordability head on. One, and I think perhaps the most important in Assemblymember Irwin's mind, provision is expanding the California climate credit. So in California, we have essentially a rebate on your electricity bill that is funded to free allocations to utilities. And so you essentially get a fixed rebate back on your utility bill. So There's direction to kind of expand that with a caveat that there's also provisions to transition from natural gas to electricity. So expenses may go up for natural gas uh, customers. But the idea here is to use that provision to make electricity cheaper. And so this is one of the main affordability provisions. There are other kind of accompanying affordability provisions, including giving the regulator more discretion to freely allocate allowances to industrial sector, which are at risk for leakage and which, provide the iron, steel, food to the California economy, prices for which are high. Um, and this is affordability adjacent, but AB 1207 also has several provisions that pertain to legislative oversight of the regulator. And what these amount to is basically more meetings between CARB and the legislature. And I think the intent of this was to have closer coordination between the regulator and the legislature. I think the impetus was affordability concerns, but I think the conversations between the legislature and the regulator will in the future expand beyond simply affordability concerns. So that's kind of number two, provisions to address affordability. And the third aspect are just all of the provisions related to offsets. To summarize, I would say offsets, I would say, are at least slightly harder to use and have been frozen at kind of their historical or current offset usage limit of 6% through 2045. In addition, there's a provision called offsets under the cap, which is similar to a provision in Washington, whereby if a compliance entity uses an offset for compliance, an allowance will eventually be taken out of cap levels. And then there are many provisions for CARB to either report back to the legislator on offsets or to update their offset protocols. So offsets are still in the program. There were proposals to eliminate offsets. There were proposals to expand offsets to 15%. Where we landed, I think, is offsets are a little harder to use under this new regime than they were previously. So I think that kind of thoroughly covers the highlights of the bills. And I'll just conclude with this last and next slide, which is kind of looking forward. Technically, we're done with legislative reauthorization. But I think in California, the carbon market is kind of past its adolescence years and in young adulthood. And for that reason, I think the legislature and the regulator will be talking about cap and trade more frequently. So there's a lot of recent and complex provisions, including the offsets under the cap provision I mentioned, where I think the legislature will have an interest in how CARB implements that provision and will be paying close attention to how the regulator chooses to implement that provision. And that's not always the case. The legislature is not always looking very closely at how CARB is implementing this program. So that's the first thing I'll say. The second thing I'll mention is there's typically usually one, maybe two meetings on the cap and invest program between CARB and the legislature. This year, because of new provisions in AB 1207, I expect there will definitely be two, if not three or perhaps four hearings between CARB and the legislature. And these are always high profile, high news events. So this year, I think, will be very active in terms of legislative hearings and regulatory oversight. And the last thing I'll mention is cap and invest is likely to feature in next year's budget discussions. We're expected to have a big deficit in California in the budget. Many advocates have positioned cap and invest as a way to fill that budget gap. And so there will be an interest in prices, their levels, and how many revenues can be expected. Yeah, thank you.
Great. So now that we've covered the legislative and kind of and regulatory background, I will talk about kind of what we expect from the upcoming cap and invest rulemaking. As Clayton mentioned earlier, CARB has sort of informally resumed the cap and invest rulemaking that was paused last year. In terms of just quickly talking about some major design topics that we anticipate seeing, especially based on the numerous workshops, informal workshops that CARB has held to date. Um, I think from our perspective, one of the most important features that actually was brought about by AB 1207 is the requirement that caps be set to at least achieve the 2030 and 2045 climate targets. And at the most recent workshop that was held in October of 2025, CARB confirmed or said that it will align the program and program caps with the 2030 climate target of 40% below 1990 levels by 2030, which translates into 118 million allowances removed from supply between 2027 and 2030. So those of you who were following the 2023 and 2024 rulemaking process will note that this number is lower than the previously expected ambition level of 48% below 1990 levels by 2030, which would have corresponded to allowance removals in the range of 180, so 180 as opposed to 118 million allowances and up to 265 million allowances. CARB has most recently explained that this change is informed by a variety of factors, including the shorter runway to 2030, given that some years were lost as a result of the delayed rulemaking, the rollback of federal incentives, and as well as the legislature's direction to consider affordability in addition to climate ambition. As Clayton explained, the new carbon offsets framework called Offsets Under the Cap requires that offsets used by compliance entities in one year be met with corresponding allowance retirements from the next year's annual budget. The formal proposal from CARB is expected to confirm how this feature of carbon offsets under the cap will be implemented, and specifically whether allowances removed in response to offsets under the cap will be in addition to or inclusive of the 118 million allowances that CARB has said it will remove to align the caps with the state target. Our view based on CARB's latest workshop is that offsets under the cap allowance removals will be additional to the 118 million allowances. Industrial and utility allocations are currently expected to decline based on how the allocation framework works. I'll highlight that affordability concerns, refinery closures, and oil supply shortages were a central topic of this year's legislative session. And on the industrial side, CARB has indicated or seems to be evaluating ways to increase leakage protection in light of anticipated allowance supply cuts. Also, in light of recent rollbacks in federal funding, uh, specifically referring to the IRA, CARB has also pointed to Quebec's approach of using a portion of industrial allowances to fund facility decarbonization projects as something that could be considered in the California context. Clayton already alluded to this, but there are a few sources of uncertainty, namely with respect to implementation of offsets under the cap and how that will impact allowance supply, as well as a potential litigation from the Trump administration. As a quick recap for those of you who may not be following this too closely, but on April 8th of this year, President Trump issued Executive Order 14260 on protecting American energy from state overreach, which specifically named California and its Cap and Invest program. The order directed the Attorney General to take action against states whose climate programs are or may be unconstitutional, preempted by federal law, or otherwise unenforceable. So we have not seen any action from the Trump administration thus far, and we do not know definitively if there will be a lawsuit. But in light of the administration's posture towards California and other state and federal climate policies, I think there's a general consensus that the threat is serious, which of course contributes to uncertainty, as does the unknown timing of a potential lawsuit. So there has been speculation over lawsuit triggering events. However, theories about what could trigger a lawsuit or when a lawsuit could come, while plausible in our view, still remain speculative. I'll move now to the rulemaking timing, or the tentative timing as presented. Sorry, we are still on the last bullet point of the previous slide. Sorry, thank you. So in the October 29th workshop, CARB laid out the timing that you see in the three sub-bullets here. Basically, the CARB has indicated that it's aiming to release a proposal by the end of this year. And that proposal is called an initial statement of reasons and will reflect the changes that CARB is proposing to make to the regulation. Once that proposal is released, there will be a comment period as well as potential additional changes in comment periods. But once that process is complete, CARB would then take the proposed amendments to the board for consideration. CARB is aiming for that to happen in April 2026, and then is aiming for the regulations to be in effect by September 1st, which would allow CARB to sort of make October allocations for 2027 vintage allowances with the new sort of regulation in effect. Now we can quickly go on to the linkage, status of linkage with Washington State, which I'll just cover in a couple minutes, as I know we need to transition to Q&A. I'll just state that our understanding, based on recent workshops and information on Washington's website, is that the jurisdictions, California, Washington State, and Quebec, have expressed mutual interest in linkage and are in regular communications about linkage. California's linkage requirements are found in a legislation called SB 1018, which requires that certain findings be made, including that the other jurisdiction has adopted requirements for emissions reductions and offset credits that are equivalent to or stricter than California's. Washington State and Quebec also have to follow their own processes for linkage to take place. On the Washington side, Washington has already initiated certain steps to facilitate linkage, including an ongoing rulemaking process to reflect recent legislative direction to further align its program with California. And as you can see on this slide, Washington's current expected timeline shows that jurisdictions entering into a linkage agreement in 2026 and for linkage to occur sometime in 2026 or 2027. On the California side, we most recently heard that Q2 or Q3 2027 is more likely for linkage to be in effect, assuming that the SB 1018 findings support linkage and that the current rulemaking is complete. CARB has emphasized the need to have quote unquote stable programs in Quebec, California, and Washington before the SB 1018 assessments can be completed. And CARB has also said that there will be a separate linkage rulemaking after this one. So all that takes some time. A key date to keep in mind for linkage is November 1st, 2027, which is Washington's first compliance period deadline. Washington has said it expects entities will be able to use California-Quebec allowances to cover emissions from the first compliant period if linkage occurs before that date. And I will stop there.
Thank you, Alicia. And that brings us